Hi, welcome to the first of the two lectures on fiscal policy in the state of Texas. Firstly, when we say fiscal policy, we refer to any policies that decide how much money government should collect in taxes and fees and other sources, and where it should use that money. The word fiscal is a synonym for government budget. Texas Constitution requires Texas's policymakers to maintain a balanced budget. This means that Texas Congress is not allowed to pass a spending bill that prepares the state government to spend more money than what it collects in taxes and other sources in an upcoming fiscal period. This balanced budget requirement doesn't apply to capital expenditures and extenuating circumstances. Capital expenditures are those large-scale, often physical expenditures that government make to obtain some sort of capital for the state of Texas. Typically, it involves infrastructure developments of various sorts, bridges, roads, and buildings, etc., that are funded by debt would be considered as a capital expenditure, and this type of spending is not calculated in the balanced budget calculations. And secondly, when dire conditions challenge the state, such as an economic slowdown, or a natural disaster or a war, perhaps, then in that case, the state's policymakers are not required to maintain a balanced budget. Balanced budget is not a Texas-specific practice. Actually, all of the states but the state of Vermont in the Union has some form of a balanced budget requirement in their constitutions. And in some states, when a state collects more money than what it spends in a particular year, then the policymakers are required to return the excess money. Typically, there's a 2% rule, so the excess amount has to be 2% at least, and they return it back to the taxpayers as reimbursement checks. This concept is called Oregon kicker, and the state of Texas does not have this practice. So I'm going back to the last slide here. Those who believe that balanced budget is a good idea argue that governments must maintain balanced budgets because if they don't, which means if they run deficits, which means if they spend more money than what they earn, then the difference would have to be financed somehow. And that somehow would be either the government taking on debt or increasing taxes later on. And both of them are detrimental for the economy. And by economy, of course, they mean the corporations, since their priorities is the corporations. They say government debt is detrimental for what economists call a crowding out effect, which when the government borrows large sums of money to pay to accumulate debt, then it would simply leave too little an amount of money in the U.S. banking sector for the corporations and consumers to borrow from. So accordingly, the interest rates for them would increase, making borrowing more costly for businesses, and so they don't borrow as much, and accordingly they don't invest as much, and then they don't create as much jobs, and the economy would not grow as fast as it could. So they frown upon the notion of government debt for this very explanation, called the crowding out effect. And they also disfavor the notion of taxes being increased by policymakers for the obvious reason that that they are concerned that the types of taxes that would be increased would be corporate income taxes, which lowers the profitability of the corporate sector. So from their perspective, these are internally consistent arguments, and for these reasons, they advocate the notion of balanced budget government. Demand-side economists reject this argument. They say that if government deficits are not allowed by a constitutional mandate, this means that government would not be allowed to run deficits, but not all deficits are created equal. In other words, there are good types of deficits and bad types of deficits, and by disallowing any deficit, we are also disallowing good type of deficits as well. And what they mean by good type of deficits is that if the government borrows money at a certain interest rate and then turns around and uses that money for whatever purpose that would bring the government a higher return rate than the interest rate that they paid at, then the return on this transaction would be a positive return for the overall society. And accordingly, or secondly, I should say, demand-side economists also consider government as a useful actor in dire economic times. So when the economy is in recession or some sort of a slowdown, then often government becomes the only institution that can end this type of slowdown, because consumers and workers who would lose their jobs in such times would not have the money to spend. And when they don't have money to spend, then corporations cannot sell their products, so they cannot spend their money for further production and expansion of their operations. So both the consumer and the corporate sector would come to an halt in these situations. So in this tough situation, the only only economic actor that can spend money and get the economy out of this slowdown would be the government, and accordingly, government should always be legally allowed to run deficits for this very reason alone. So this is the argument that demand-side political economists put forth in rejecting the notion of balanced budget as a constitutional mandate in a nutshell. When we look at the sources of revenues for the state of Texas, we see that nearly half of the money comes from taxes, and about a third of the money comes from the federal government, and the remaining part comes from various sources such as the state lottery. So this brings us to the discussion of taxes in the state of Texas. By far the largest or the type of taxes that is the largest portion of the tax revenues of the state of Texas is the so-called sales taxes. And as you know, these are the type of taxes that we all pay every time we buy a consumption item in the society, in the economy. Currently in the state of Texas, this rate is 6.25% of the purchase price of the goods and services sold. Texas is one of the highest ranking states in terms of sales taxes. We're the 10th state with highest sales tax in the union. And on top of that, Texas Constitution also gives local governments, so county and city governments, to add another 2 percentage points on this sales tax rate. That's why when you travel in Texas and you go from one town to another, if you buy the same product and look at your receipt, you may see that a different tax percentage is printed on the receipt. The last slide is those that you see here: oil production tax, motor fuel tax, natural gas production tax. These are all types of taxes. The second most common type is this type of tax, excise taxes. This is basically similar to sales taxes in some ways, but they are typically on those products that the policymakers find to be somehow less desirable for consumers to consume. So the idea behind this type of tax is not just to raise government's tax revenues, but also create a so-called disincentive for people to consume less of these products. So these products, some examples of them are gas, which creates environmental issues, as you know, pollutes the environment enormously. Tobacco, which creates very big health problems for the society. Alcohol, similar. It's linked to many problems, from domestic violence to accidents on the road to just general economic productivity going down, and also firearms, which creates a different set of issues that we all are very familiar with. So this approach to taxation, the idea that taxes can be and should be used to curb the consumption of certain items that are not desirable, that are not, or in economic language, that they produce negative externalities for the society, is called Pigouvian approach, named after a British economist by the name Arthur Pigou. Pigouvian taxes and excise taxes are an example of this. These types of taxes are different from sales taxes in four main ways. Firstly, they seek to discourage consumption, as I mentioned. Secondly, they are typically charged on the producers directly. So whoever, for example, tobacco company that manufactures the cigarettes, are charged this tax instead of the consumers, the people who buy cigarettes in the store. Of course, eventually it's still the consumers paying for this, since the producers shift these costs to the consumers, but at least directly it's the producers and consumers only indirectly. Whereas in sales taxes, consumers are charged that amount, not the producers. A third difference is that excise taxes can be a fixed amount per unit, not, as well as a percentage of the sales price. So, for example, taxes we pay on gasoline is per gallon sold, regardless of the sales price of the gas at that time. And lastly, it applies to much fewer items. The sales taxes apply to pretty much all items in the economy, but there are just a handful of products that excise taxes are applied to. The next type of taxes we need to discuss in Texas is property taxes, also known as ad valorem taxes. And these are the taxes that homeowners or other property owners pay for the owners for the ownership of their properties. These are paid based on a percentage of the current market value of their property at the time of the taxation, and is paid every year once, and so not when the property is sold, in other words. So if you own a house, you pay it every single year, not only when you sell it to someone else. Sales taxes are a different rate in each county. They are determined at the county level, but when we look at the average property tax rate in the state of Texas, Texas ranks as the sixth state with the highest level of property taxes in the United States, 1.83% versus 1% nationally. And this is largely because Texas is a state with no income taxes, so the difference is collected from the property taxes. We will discuss income taxes and its impact in Texas economy and government in the second part of this lecture.